Goldman Sachs out with a bearish call today on machinery stocks. The firm is removing Caterpillar and Deere from its conviction buy list, saying they underestimated the risk of trade war tensions. We made it our call today. Steph, you own Cat. Weaker crop prices they worry about, input cost inflation, further trade war escalation.
I don't worry about Cat as much as I do Deere. I think that the Deere call makes a little bit more sense to me. And anything ag has just been killed this year, right? So, I mean, I own Dow DuPont, and that's just been miserable. But I do think that Cat is worth a look here because it's down 12%. It trades at about 13 times forward estimates. It almost yields 3%. That in itself. So those are the metrics. But you're just beginning to see oil and mining CapEx numbers go higher. This company also has done an amazing job over the last several years restructuring, and the new CEO is focused on profitability. So I think there's upside to margins. And most importantly, in terms of raw costs and the pressures there, they have pricing power. So I think they'll be able to manage through this. And don't forget, these guys, they beat by a lot last quarter, raised guidance by $2 for the full year. And the stock went down, obviously, because of concerns about trade and because of peak cycle. I still think that there's longevity in the cycle.
It's interesting, Jim, that both stocks are higher on this move. And they've tracked each other pretty well over 1, 3, and year to date. Year to date, they're both down 13%, as we just said. Cat in the near term's down 8.5%, as is Deere.
Yeah, well, Cat's the one I'm most interested in, and it's basically been in a bear market since its January high. I think this is all on the trade war issues. So for the Goldman analyst to say that, you know, it's going to go down from here or not to buy it here because of what's going to happen with the trade war, I think that call should have been made 5 months ago. Now the call you have to make is whether,
no, but it's a updated view, perhaps, that the trade war was.
Well, that's okay. So that's exactly where I'm going. You have to make a call here on whether the trade war is going to get worse or better. And we can't ignore the fact that there's an election coming up. I mean, the current administration has to figure out something to ameliorate this trade war issue between now and November. I think that's likely to happen. With Cat at 11 times earnings, a PEG ratio of 0.6, I'll submit to you.
You're approaching that, though, is that the president or his base thinks that this trade war is a bad thing. You're saying that there has to be some positive outcome.
Well, the reason I'm saying
the midterm elections coming up.
You are
That's
correct.
Your own personal perspective on it.
You are correct in what you're asserting. I'm saying that if things with this China trade war continue the way they have gone for the last few months, that it will put in jeopardy at least the House of Representatives staying in Republican hands. Now, I'm not trying to play a political expert here. What I'm saying is I think there's room for the trade issues with China to get better. I like the entry price here. All that said, I don't think things with China are going to get better over the next few weeks. I think this is a late August, early September timeframe. You probably get it at this price or slightly lower. But to think that this is a sell here, I think, Steph, you're right to own the stock here. I think I will be with you in this stock in late August or early September.
Yeah, if you didn't own it, Scott, with it down the 13% that Steph cited or whatever right now, they just cut their price target 19%. They're late. I agree with you, Jim, that they're late doing that.
By the way,
it's already down 13%.
The analyst
here.
kept a buy on the stock, so he just took it off the.
But he took it from 221 target down into the 180s, I think.
One of the important things, you just got to look at commodities.
So I disagree with him.
Look at commodities. I mean, you look at oil prices. Oil, it's 65 to 75 doesn't matter.
No, but you're assuming though that this commodities run has more gas.
I mean, I think you have a range in terms of oil. I think it's 65 to 75, and that's just fine for Caterpillar.
It might be easier.
Just fine.
It might be easier to say what we're not assuming. If you don't like the stock here, or if you do like the stock here, what you're not assuming is that there's going to be a recession catalyzed by a trade war getting worse. So I don't think there is going to be a recession catalyzed by the trade war getting worse, which is why I think Cat at 11 times earnings, a 0.6 PEG ratio, it's priced for a recession.
The one thing the commodities run has not had is any gas. It's been missing natural gas. I would wait on this call until they report earnings, which is Monday, July 30th. I don't understand putting this call out ahead of earnings, which arguably could be one of the bigger quarters for Caterpillar in quite some time. I think Deere follows it up about 2 weeks later.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.